Okay, folks, we're looking at the Euro USD. Okay, and we're going to be looking at an ICT buy signal, or for an example of a ICT short-term buy. And the two primary patterns I trade is a turtle soup or a first return is a turtle soup or a first return optimal trade entry into an order block. This trade that we're going to be showing you here is framed on the basis of a turtle soup. That was the origination of the move, would cause the market to suggest higher prices. Again, it's being the daily chart. Price moves down and rejects. Okay, we are not in the move yet here unless you're trading a break below this low here for a turtle soup. The optimal trade entry into an order block is going to be seen by taking the down candle and the high. What we do is we take that as our range for institutional support. You see price comes right down into it here, right on this day here. It comes in at February 12th, 2014. Now when price drops down into this price level, we would be hunting buying opportunities once it trades down inside this range. Now the high on that candle comes in at 135.71 and the opening is 135.57. So very short range in terms of what we'd expect to hunt an entry in, but we would be looking for the minimum threshold or first level at which we would hunt the long opportunity at 135.71 with the expectation of allowing price to dip down as low as 135.57. Okay, and here we are on the 4-hour chart looking at price action as it dipped into this area right here. Okay, we have it here as well. Okay, and we also have a down candle prior to the move up, which is what we are looking for an optimal entry. And when price drops down into this level here, this is the very moment or very instance you start to take an entry, or you do your long entry. And now the time of day for this particular setup is 12 GMT, which is a classic ICT New York Open setup. When an entry on a long basis is entered, the first thing you're going to look for is where is your risk going to be. Okay, and whenever we're looking at ranges, we have to consider the mean threshold. Now the mean threshold is basically the 50% region. Okay, and I'm not going to show it on there. Whenever we look at ranges, we have to consider the mean threshold. That means the minimum level of which the range is outlined. So in other words, if you have a range of 100 pips, 50 is basically the mean threshold, okay, or halfway point. Generally, we'd like to see the 50 to 100 pip range to act as support for moves that are dropping down into a bullish order block. And we like to see for instance, if the range is 100 pips, again, 100 being the high and 0 being the low end of the range, we would like to see the 0 or minimum threshold up to the 50% or 50 pip range for the optimal level for selling short. And what do I mean by that? Well, if you take this area in here and we say, for instance, this is the total range, okay, and it happens to be 15 pips. 7.5 pips into this range is about the midpoint, and we don't want to see a move dip down below that. Okay, so what that means is if this is what we're looking at, okay, right about there, 7 pips, okay, we want to go at least 10 pips below it. So there's your stop. I'm sorry, there's your stop right there. So this is where your stop loss would be. Now, if you want to be a little bit more conservative and allow more, um, um, I guess, movement, okay, you can go with a 20 pips below the mean threshold, and that would be your stop as well. Okay, and you define your risk based on your equity with these two price points at which your stop would be placed. Okay, so we have two areas at which your stop loss could be used for the long entry. And you want to be using the spread for your purchasing on long entries. You don't have to factor so much on selling short because you're usually selling the ask price on most of your platforms, if not all of them. If, as a matter of fact, the long entry always has to factor in that spread. So if you're looking for an area down here to be a mean threshold, you got to allow a little bit of, I guess, human nature to come into your trading a little bit. So that way, if you're looking at this upper level here, 135.71, which again is the high on this candle over here, which is the minimum threshold we would expect to see price to reach down into. You want to take that level and at least add 3 pips to it. Okay, so again, that would be 135.74 would be your entry. Okay, down to your stop here, which would be in this case 26 pips, and down here would be 36 pips. Okay, so if you want to be conservative, your stock could be around 36 pips or 26 pips. Okay, allowing for movement because we're looking at a 4-hour chart. Now, this is for folks that don't want to have to be in front of the charts. They want to be away, being able to have their job, be able to do the things they normally do on a daily basis, and not be so required to be in front of the charts all the time. You could set this trade up pretty much on an autopilot. Buy stop at 135.74 with stop loss at 135.38. There's your risk. Okay, it's defined. Your entry would be taken upon in the form of a limit order. You'd be taking long entry basically on a limit. And where would you be looking to take profits at? Well, the range at which it's dropping down into, short-term trading is highly effective when you use old highs and old lows. And we're going to see that here. Okay, so we have an old high. So we'd be going long in here. So this would be your defined risk. And your expected profit essentially 4-to-1 almost. Okay, so if you take an exit on a limit above this high, which comes in the form of 136.84, so if you looked for 136.85 as your exit, your risk to reward would be, in this case, very handsome. Now, you take out the largest portion of your position at the high, okay? When that happens, for instance, let's say you take 70% or 75% of your trade or 80% of your trade off at the old high. Okay, when price gets back to that point, because you don't know with any level of certainty that the price is going to stop right there or if it's going to continue. Now, ideally, we would like to see it continue and just blow right on through and continuously move higher, but you never know that. Okay, so the highest probability in terms of trading is working within old ranges. Okay, same way we saw this low here rally up, it retraced but didn't take out the old low, which is what we would expect to see for an ideal entry. Now, the reason why that's ideal or optimal is because we have this old area or range, which is defined by these two orange lines as well. We're just using a shaded box here. When price drops down into it here, when that happens, what what the market is suggesting is that this is a return to old buying, because market makers and smart money, they buy during market moves going lower. Okay, they have to do that to accumulate the positions and get their ideal entries. They cannot buy as it's going up because it's going to give them a very inefficient overall price for their positions, because they're scaling in and out on large positions. They're not taking these little tiny little minor moves that we do as retail traders. So with that in mind, going back over here, because we're working in the old range of this low to the new high here, when price trades back down, our belief is that this low is going to maintain. Now, do we know for certain it's going to happen? Absolutely not. But because we're trading with a probability that we had a rejection of this low, price is now showing a willingness to rally up. The down move prior to the up move that we've seen in the price swing indicates that this is where the smart money began buying. So this is going to be the beginning point of a new capitalization of this down candle or ICT bullish order block. With that said, for this instance over here, once we take the long, we don't know if they're going to need to go back down into this order block again, or down as deep as halfway or the mean threshold of this bearish candle, which would be a bullish order block. They could come right back down there again and dip into a little bit deeper at 135.25. We don't want to sit through that. Okay, we don't want to sit through that. So what we're doing is we're taking positions and paying ourselves rather handsomely, because overall, if we consider the range at which we would be looking to get long on, in this case it's 111 pips, okay, which meets the criteria for uh, the range or duration or magnitude, if you will, of the trades that these types of setups provide. Now, once the move starts to take place, and if you take 75 to 80% off of your trade here at this old high, what do? Well, you're going to leave that remaining portion on with a break-even stop or plus 10 or plus 20. Okay, whatever your fancy is, it doesn't make a difference, okay? But nonetheless, you don't ever let it go down to zero. So you're going to have to at least factor in something, even if it's a couple pips, 5 pips or something. Just bring it to a point where you're not going to lose any, and even if it was to wildly stab down into your stop, it ain't going to give you any slippage either. So now, when you're in sync with the daily chart, you're in sync with the 4-hour chart, you're leaving that smaller portion on. Okay, and now what's going to happen with that smaller portion is at a later time, you may get an additional buy entry. Okay, so we have a consolidation in here and an overall existing up move. Now, all this, we have to kind of like pretend we don't see this. Okay, now I know it's hard. It's like the elephant in the room, and it's just the perfect example of classic hindsight. I understand, but you want to learn how to do this. This is how you start. We have a low here. Price comes up and then falls and breaks through it. This was a run on stops, and the way you can take additional trades is we already outlined the framework for this entry here was on the basis of a turtle soup on the daily chart. Well, now we're seeing one potentially form on the 4-hour. So when the 4-hour drops down, blows out those stops, we can get long on that idea as well. Now also couple that with, and you probably already noticed it on the chart, some of you folks that have been working with me for a number of years, we have another large down candle, okay, which is where all the buying takes place into this move. They were buying all the way through all this, and then boom, turns it around. The high of that candle to the opening price. Okay, let's see if we can get this to come up here and work with us. Okay, the opening is 136.33, high 136.51. So what we'll do is go over and grab another rectangle and we'll highlight the high down to that opening on that candle. Okay, and price, if it comes down into that area, we have one of the strongest setups you're going to be able to see is a potential turtle soup long entry, which is a run on stops, and down into a previous order block. Okay, now admittedly this is a rather large range, but it's a 4-hour chart, so you have to keep that in mind. Okay, not that you need this, not that you have to have these in your setups, but this is your Fibonacci, okay, from the very, very, very low all the way up to the high. You see that? And the 62% retracement level comes just a little bit below it, okay? Now here's one of the things that I like using, and this is why I talk about candlesticks in the way that I do. I don't like using the wicks unless I'm referring to it in this capacity. Okay, finding the high to the open for bullish order blocks and the low to the open. I said that wrong, I'm sorry. The high to the open for bullish order blocks and low to the open for bearish order blocks. Okay, so whenever you consider the wicks, they're the only times I ever consider wicks on a candle. Okay, I like the bodies of the candle. So if you look at price action and you study the overall movement between price swings, highs and lows, I want you to do this, especially if you're working with a higher time frame chart. If you look at the bodies of the candles, okay, the bodies of the candles to the high and low between the two price points. For instance, we have this low to this high. Now this is the highest high prior to this dip down. If you take the bodies and incorporate that, and that's here, okay, we have this right there. This is the true range, even though they have this inerrant price wick, okay. Let me zoom in. We have this little wick here, okay. That's the thinnest price action on the move. So what I'm doing is I'm using the lowest body point of reference right there. Okay, you see that? And now I'm going to use the highest body in all these candles, which would come in the form of this one right there. You see that? So now what we've done is we've filtered out all of this noise. Okay, all these little wicks, and we filtered out this wick as well. Okay, since we're doing studies on true range and the premise behind real support resistance or institutional as it were, okay, this defines the range a little bit better. Okay, it gives you a lot more clear indication of where the high and low is, and it allows you to kind of like be aware of the wicks, but don't draw so much attention to them because they're not going to be as paramount as you'll see in a moment. So now looking at this, again, we have the 62% retracement level, just a little bit too short of reaching it in terms of the Fibonacci level. But that level right here is 136.46. Now, if we're buying, okay, if we're buying, we always have to add the spread. And again, like earlier, we used the standard 3 pips to get you in on this setup down here. Okay, I've said it earlier in my teachings, tutorials, and my studies as it relates in even live session rants, if you will. My entry or my form of entry, okay, on longs is typically I add 5 pips. I just round it to an average of 5 pips. Okay, and if you haven't picked that up throughout my teachings, you clearly are getting it here. You add 5 pips to your long entries, and I'll subtract 5 pips on my shorts. So in other words, I'll try to get in a little bit early, and sometimes I'll be buying ahead of the level that I expect to form as a support level. And the reason why is because 5 pips is going to make or break me if I'm using an average of 30 pip stops. And again, that's the reason why I like 30 pips, because if it's a 20 pip range that I think the trade's still good in, and I'm going to factor an additional 5 pips for spread, that gives me a fudge factor of additional 5 pips beyond that. So it builds in a lot of handicap, in my opinion. Probably some of you, it's a little overkill, but I don't want to be in front of the charts all the time. So that's just one way I've overcome that. So by having 136.46 and adding 5 pips to that, your entry would come in around 136.51. So 136.51 is right here. The low on this candle comes in at 136.48, exactly 3 pips. So in this instance, I'll leave it up to you to decide whether that would have been a factor for you or not. If this is problematic for you, okay, if this is problematic for you in terms of getting in on limit orders, and you would rather be in front of the charts, this is what you do. We already have the framework where we have a low, they're running the low, okay, and we already have an order block at which we expect the price to dip down into. We also have another short-term low right here, okay, so we have another scenario of potential turtle soup. Now I already know what you're thinking. Well, why wouldn't we expect it to rally once it cleared this low? Why wouldn't we expect it? Well, it doesn't dip down into any order block over there. The order block begins over here. So even though it takes those stops here and does a little bit of a wiggle and bounces up and then comes down, where does it go? Right into the order block after it takes out another short-term low. This is a very classic scenario where they have a low form right above an order block, which is referred to earlier in this series as crouching above an order block, which is they imply that the market has already turned, and they show a sharp little rally away, okay, and it looks good on short-term time frames. So everyone starts to dogpile on top of it. What do you think's happening right there? As soon as that takes place and it starts to rally up, everyone and their brother is going to have their stop loss right underneath that low. So what is that going to form? Sell stops. Okay. So why would they be willing to drive the price down in there again? Because all the sell stops become active. Who would be interested in buying the sells that are trying to get out of their long entries if they tried to buy this as a low? The smart money. So they are forcing or engineering more buying liquidity in addition to what would already be resting in the marketplace with this order block as well. So then you see this very extreme vault in price. Okay, and again, I want you to focus on the fact that we had just the wicks dip down. The bodies really didn't work down that far. Okay, we only wicked into this order block, and only momentarily. So this suggests that there was a whole lot more liquidity provided by the run here, initial little short-term low, everyone putting stops below it, bang, that was a lot of the necessary liquidity to get long, running out sell stops, and returning back to an order block, classic scenario, boom, takes off. Okay, so you can take the run below this low right as it does it. Right as it does it, and this candle would be a big, bold face candle going down. And I know that's very scary for some, especially that are new. You will be very shy to want to take a trade like that, and I understand that. I understand the unwillingness to be uh, ahead of the market, where you're just really watching the price to scream lower, and you go in, you're buying that. It's very, very problematic for new traders. But when you understand order box and you understand support as it relates to institutional level trading, then you won't fear that. In fact, that's the very thing you will be looking to do. You want to do those types of things because you end up getting over the dealing spread very quickly, and you'll get closer to your profits a lot faster. And you see the price moves rather dynamically away. And again, the same thing we use with the entry over here. We're looking for the old range to take profits at. Okay, well, from this low, or the area at which we would take price for a long, we have the range defined by the high up here. Okay, now this is where we would use the wicks because it's at the extreme. Okay, so we could take, I'm just going to borrow the fib just to utilize the trend line aspects of it here. The high up here coming in at 137.75. So getting long down here at 136.60. The range for this particular setup. Okay, and we're going to assume we just bought just below the low here using turtle soup. And the range comes in at 115 pips again. Okay, and again, this is another setup that took place the very next week on the fiber. So you're not trying to take a trade every single day. That's not the nature of short-term trading. Short-term trading is looking for very high odds conditions, looking for high odds of profitability with very low risk, very, very low risk. Which brings us back to, and I skipped over, I apologize. If you're looking to get long down in here, okay, whether it be a break below this on a turtle soup, okay, and again, to reiterate, when you're looking for turtle soup long entries, you have to identify where short-term lows are in a bullish market. So you have to have a premise in mind that you're expecting higher prices, preferably on the daily chart. If in the better scenarios are when you're looking for bullish prices in the daily and the 4 hour, when it's so poised to go higher on both those time frames. If you look for a low to get violated, once that takes place, anticipate the market to move higher because it may be just dipping down here to run stops and then take off. And I challenge you to go through your charts and see how many times that happens in a bullish market. The market will come down, take out a low, and many times you won't see it so many times on the daily chart because that's the directional premise indicator. It tells you which direction to be trading in. But looking at a 4 hour, 1 hour, and 15-minute time frame, you'll see lows being cleaned out intraday, and they'll accumulate all those stops that are in the form of sell stops. And then once they're drawn into the marketplace in the form of selling it to market, because that's what a sell stop does become, it evolves into a sell it to market, and that means it's a flash flood of liquidity for the sell side, which produces the counterparty to what smart money needs as their willingness to be a buyer. They have to have someone else take their trade. So what this does is it pairs orders, okay, and it forces liquidity and engineers liquidity in the marketplace that otherwise, in the trader's mind, they're just looking that they're getting out. That's their only mindset. They just think if it goes down below this low, they don't want to be in the trade, so therefore they're using it as a form of insurance. The smart money is using it as a form of business transaction. They need that other side of the trade to be counterparty to facilitate their speculation or even a business transaction. Okay, so it forces liquidity in the marketplace around the intended price level. Okay, so if we have this range here, how do we define our risk as well on this trade? Okay, we have, I'll just use one of these little guys over here. Okay, so 136.42. There's the mean threshold, so you want to go below that a little bit. Now I realize that I'm showing you the non-real time in the front of the charts all day long approach, and that's the reason why I'm showing you this one first and not going down into the lower time frame, because I want you to understand that there are ways to do this and not be stuck in front of your charts all day long. So if you're going to buy a break below 136.64, you can do 136.60. Just go to a small round number, 136.60 right here. Okay, and drop that down into the mean threshold here. So you're going to have to go 10 pips below that, so 29 pips right there. Right there. That would be your mean threshold, and 10 pips below it. So you have to have stop at 136.31. Okay, so just take whatever amount of risk that you're willing to assume, divide that by these number of pips, and that is your risk. Now to get back to the old high up here, okay, what you're going to do is you're going to see the range, and we'll just change this to a green or something, just for contrast. Two, three, again, 4-to-1 scenario. Okay, so you're risking 2% down here. Payout is 8%. Very similar to what you had over here, just getting back to its old high. And again, that's not saying anything about the remaining 20% on this old position. That's still in effect over here. So now you have 20% of the old position from this low down here, in addition to what you have here. So when the market comes back up to this price point here, you take again 75 to 80% of your trade off, move your trade back to the position you assumed here, move it up to plus 5, plus 10, plus 20, just something above break even. You don't want to have any likelihood of it moving back and taking your stop and taking you out of the marketplace. You want to stay in the position. Okay. Market trades up, makes it a little bit more of a move. Now, in addition to, if you don't want to hold on to longer term trades and you want to just get that full profit effect, okay, you can take your extensions from the move from the high down to the low and do Fibonacci extensions. And that looks like this. Okay, I'm going to show you this one first. Here's your 162 and your 200 extension. So if you bought down here, you could take 70% off or 80% off your trade here, okay, and let the remaining portion run up to 200 or 162 or 127. You can see the 127 got hit here, 162 got hit here, and later on 200% got hit there. Okay. On the secondary position, now this is later in the move, so you want to be a little bit less aggressive in your profit objectives. So that's 127, 162 extension, not so much relying on the 200% so much on this one. From this high broken here, it comes up to the 127. Price again runs up, boom, 200% as well. Okay, notice you did not get stopped out here because you're trading with institutional order flow on a daily time frame and in line with the 4-hour. So now you have the 20% remaining from this long entry here, the 20% from this position here. Okay, and let's put this in perspective for a moment. If you were long down here, and I'm just going to round it to 3,600, we'll say 3,600 is the level at which you would have got in. And it may not even be that price, but just for simple math's sake and to make things a little bit more streamlined. From here up to essentially 37.80. So we have 180 pips or thereabouts. Okay. Price gives you another opportunity here. Okay. We'll say you got in at 136.60. It goes up to 3,900. So 240 pips in addition running higher. Okay. But you only had, say you bought one standard lot. Okay, down here at the low, and you bought one standard lot down here. Well, you only have 20,000 leveraged here, and you have 20,000 leveraged here remaining. So your entry down here had 20% of the trade left on. Remember, we took the position off here, left 80% in our bank and 20% in the market. So when price continues up, when it retraces, we're only sitting through a small little retracement, okay, on a balance of 20% from the original position down here. The long entry we take here, we peel off 80% of it here. Okay, so now during this whole drawdown here, okay, the only thing we're feeling is 20% of this position, but it's being offset by the 20% that you have down here. So you're not really feeling any pressure at all. You're still sitting in profit. But what's happening is you have 20,000, okay, leverage or basically $2 per pip and $2 per pip here, or $4 per pip basically, working for you from this new reaction. Now, this move here, all this is only retracing back into an old order block. This rally up. Let's get another range. In here. So we use the down candle, the high to the opening price right there. Again, the middle of the range is what we're looking for. We'd like to see that. Okay, if you want to take an additional entry, this is where it would be. But if you want to hold on to the position you assumed and just let it run for you, and you don't want to assume any new position or build in more position, because that's just what this is. I'm showing you how to build in positions and still be profitable, paying yourself and still building in positions. Okay, you could add another standard lot here, okay, and do the whole thing we did here on both of these positions here, doing 10 pips or 20 pips below the mean threshold, using that as your stop loss, okay, and then getting back to the old high here, take 80% off of it here, and let the remaining 20% run, okay, and then ultimately the 20% from the original position, that's the level it's reached right there, okay. Having done that, quickly you can see how fast that even the small remaining pieces, and we'll say that you took position here as well, okay, and you had basically $4 I'm sorry, $6 per point, or pip rather, and the move moves essentially 165 pips. So that's almost $1,000 just in the move here on the 220s. I'm sorry, the 320s that you had. You had 20,000 leverage here, 20,000 leverage here, 20,000 leverage here. They were the balances of the original standard lots that you went long at, because you went standard lot here, which is basically $10 per point, then one standard lot long here, a new long entry, okay, which means you have what here? Total, you have $12 per point making profit, okay, runs up, okay, once that happens, you take out some profit here, you let some of this retracement take place, and you buy another standard lot here, boom. But now you have $2 per point from this long here still, and you have $2 per point from this long here as well. When you buy into this one, you're going to have another standard lot. So now what do you have per point? $14 per point. Runs up to this level here. You're going to take 80% of it off here, okay, leaving 20% of the position you assumed here off. Now, this is where you're going to have some problems in the States, because first in is first out. Now, the way I overcome that is I actually have multiple accounts. So if I'm going to work in a position in the same currency, and I'm building a position like this, I will have the positions spread over multiple accounts. If you're not in the States and you don't have that rule, you don't have this issue. Okay, but nonetheless, you're going to take some profits out, okay, and leave it run. Just on this position right here, not counting any of this stuff down here, okay, just this position here is almost $1,000 with the 20% left here, 20% left here, and the 20% left here. Just this move here is almost $1,000. It's $980, $990, something like that. The long here to this old high in here, that comes in the way of almost 100 pips, well, 115 pips. Okay, so you would have almost $900 there as well. And down here, I think we figured out it was 100 pips or so. Again, another 800 pips. So inside of about a month, okay, less than a month, you're making $3,000, okay, trading short term. You're not trading aggressively. You're controlling risk. You have very handsome risk to reward, 4 to 1 on average, okay, which is absolutely millionaire making. And you're scaling out, but leaving small pieces in, allowing higher level daily institutional order flow to pay you as ranges expand on the upside, okay? Now, that's the approach of using the short-term trading with not having to be in front of the charts, not having to be sitting in front of 5 and 15-minute charts all day long, okay? If we go down into a let's go down to a 15-minute time frame. And yeah, we'll start there. Let's go down to a 15-minute. Okay, and here's what this move looked like on a 15-minute basis. Okay, the drop down, which is scary. Most people, they don't want to do any kind of buying in that indication. Move starts moving higher. Let's put some day dividers in. Okay, on a Friday we close, and then continues moving up. Sideways consolidation, rallies away. Okay, can you see the stark contrast to what was being shown on the 4-hour chart? How much cleaner that was, for at least as it relates to looking at short-term trading. The ranges and the levels at which you would be hunting are very clear and easily seen. Now contrast that with what you're seeing here on a 15-minute time frame, because everyone thinks the 15-minute time frame, the 5-minute time frame, or even 1-minute charts are going to be so much more useful to you because they're close to the market. Well, you're so close to the market, you can't even see what's going on. Okay, it looks like noise. And you can see clearly this is rather erratic. Price runs up, makes the move to this level in here. We're sweeping into this area here, right in here. And on the 19th, let's see what the 19th is over here. It's the 14th. Here's the 18th. Here's the 19th. Say here, this is the high. You're seeing this form here. This daily high and this daily high is this daily high and the higher second daily high. So we're seeing this area right here in price action right there. Okay, and price drips down into an old area of institutional order flow. The big rally up, they were buying here. So when we went back down to it again, boom, it rallies again. Okay, this is a London close trend continuation. Okay, runs up into an old order block, retracement, blows down into this order block. Everything we noted on a 4-hour time frame, we're seeing it here. Okay, you see that? Down into the range. We're dipping down into it here. 136.50 is what we would expect. What am I saying? 136.50. The low on this candle. 136.48 and the high on this candle. 136.51. So 136.51. Yeah, we would expect it to drop down 136.55 for an entry. Right in here. Get long on a London Open kill zone entry. And it's also turtle soup. So now we're looking at more of an intraday basis entry style. So we have the low here. Price drops down into this level where stops will be resting. Right there. Let me make that a little bit bigger. Okay, so stops resting below this low. We dip down into it. We want to be buying that. Why? Because you're inside of a daily order block right in here. They're building accumulation positions here. Sell stops will be accumulated for buys when it drops down in here. All this little area here, you want to buy it. Buy, 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 buy. Okay. Boom, takes off. Okay. Once this takes off this high here, you know you have market structure back in sync with you. So your lower time frame is now in sync with higher time frame institutional order flow, which is bullish prices. Okay. So now what you're going to be looking for is on the daily chart, we have this old range high up here. So because you're buying down here, don't take 20 pips. Don't take 100 pips. Okay. You want to look at where the range is. The range is that old high back up in here. Okay. So you're looking for a minimum of 137.75. So 137.75, which is up here. So you're buying down here with the expectation of making profit up here. See the difference between that and day trading? You're not looking for these moves to pay you, 20 pips, 30 pips, and then move to the sideline. You're waiting for these setups to give you absolutely spectacular entries for big magnitude pit ranges. You want to see that type of payout for your trade. So you're buying down here, okay? If you use your standard London Open entry format where we use a 30 pip stop, buying in here, okay, around 136.55 or even 136.60, 136.30 with a stop down there, you're risking 30 pips. Right here, you already got 1 to 1, 2 to 1. Let's see what the actual So we have 6-to-1 payout on a long entry, trading with institutional order flow, London open, okay, and looking for a range expansion to the upside. So every time we get a little bit of retracement, we're expecting to take the highs out, okay? And see what we have here, we have basically two equal highs. What you're seeing there is them engineering additional liquidity. So they're going to be buy stops above, above these highs. They're going to act as buyers for the selling that they took place here. So they're going to stage some selling in here. Then you have the old high back here. Okay, they'll sell through all that and above 137.75, which is the old high seen over here. Okay, you see all this big caffeine bar here, big press through it. Okay, that's them liquidating a lot of the longs down here, and down in here. Okay, they're taking big profits in here. Runs it through, and then we have a little bit of a profit. Market takes a breather, retraces. Right in here. Doesn't look like much on the chart. But right in here, I'm purposely keeping you in the dark a little bit because I want you to see why looking at just short-term time frames is not good for you. It's not good for you at all. But here is your order block. Okay, this big move here, this extrapolated move up here, in this range is where you'd be hunting longs. Fine tune it down to this level here, right there to the opening and high. You'd be looking to be a buyer 137.11 or 137.15. Okay, if you risked 30 pips stop below it, okay, 30 pip range, okay. So buying at 137.15 and your stop, well, oops, good grief, it didn't even do that. Okay, so here's your range of risk and your upside. Again, keeping in the form of trading only in the higher time frame institutional order flow. Objective, reaching higher for prices. You're looking at entering again around 137.15. Okay, right in here. Okay, looking for the old high back here to get back to. So the high comes in at 138.27. Okay, so what we're going to do is we're just going to change this to 138.27. So that line will be waiting for us when we start to move higher. Again, that 138.27 is this candle's high up here. And this is the long entry you're looking at down here. All of this is happening right in here. Okay. Now it's assuming you're in looking at it live as it's happening. Okay, so again, we're in another we're in another New York open and London close continuation in sync with the higher time frame. Okay, and 138.27 is tagged right in here, and you can see it's almost 4-to-1 payout if you're just looking to take price as an exit at 138.27. You always want to give a little bit of room to go through it. So you take, again, 20%, leave in the marketplace. If you bought another standard lot down here, $8 per pip gets closed here. $2 per pip is remaining in the market. And you get this huge caffeine bar still that you're in. Right in here, moving up to 139.15, which is this high here. 139.16, and that's this high right here. Okay, so taking $8 off per pip here, leaving that last 20 on, getting out at 139, big figure, explosive, huge move. And you're looking at 400 pips or so, okay, in terms of the overall price move. And you short-term trade it the same way, just reversing everything we just shown here for going short. So you look for bearish order blocks or institutional order flow on the daily, and then the 4-hour, once it's in sync, start looking for bullish order blocks, or bearish order blocks to be respected, and start looking for ranges to be blown through, taking out support levels, looking for old lows to be swept and take profits at, and that's the bare bones of it. And the ideal scenarios are going to be set up around buying for lows on Monday, Tuesdays, and Wednesdays, and selling short highs on Monday, Tuesdays, and Wednesdays. Okay, and expecting that weekly range that we taught in other tutorials, waiting for that to expand and move in your direction. Okay, so that's going to be it for this teaching tutorial. I think coupling what you learned here in contrast to everything else that's been shared in the ICT library, you have everything you need to be profitable in your demo trading and your developing. And I wish you good luck and good trading.